mean, it's funny you said the markets were up, and I guess it depends on what market you're looking at, because S&P is down, Dow is up, NASDAQ's down, so it's kind of a mixed bag now. But in general, I think, we had this 10% correction, then we've had a bounce off the bottom and recovered about half of that at this point, a little less. And so I guess the inclination is to say, well, that was just, we needed the correction and the opportunity to buy at better prices, as they would say. But I don't think anything has changed fundamentally. If anything, there seems to be even more uncertainty around policy coming out of the administration. That's, I think, one of the major issues for the market. And it was reinforced this morning. The Richmond Fed, in conjunction with Duke University, does a quarterly survey of CFOs, and they came out and expressed a little more pessimism in the first quarter. And it was entirely around uncertainty relating to policy. And the tariffs were obviously kind of front and center in terms of their concerns. I think tax policy probably secondary. They were obviously quite optimistic about the regulatory backdrop, but the tariff thing is kind of this looming unknown, both in terms of timing and expansiveness. So it's hard for them to make decisions, understandably, in an environment where they're not really sure whether their supply chains are going to be disrupted by these tariffs or not. So that's kind of stifling a lot of what would be CapEx and hiring. And interestingly, and I think we talked about this when we chatted the last time, that at that point, the University of Michigan sentiment survey had come out and reflected incredible pessimism on the part of consumers about the labor outlook. And I remarked, I believe it was in our conversation, that, they tend to lead the actual data because they have a much better real-time sense as to what's going on out there. So it was kind of reinforced with the CFO survey, where they're kind of sitting on their hands a little bit in terms of both CapEx and hiring. So in that regard, it's hard to see where there's any basis for this sudden reversal in the stock prices, other than, you had a correction. And for those who were still bullish, it was an opportunity to, buy it, like I said, better levels. But nothing fundamentally has changed near as I can tell. And we'll get an update on the Atlanta Fed's forecast for the first quarter sometime in the next, probably while we're having this conversation. But they're at, roughly minus 2% for the first quarter. And their consumer spending component, importantly, is almost zero. If it actually prints at that level, it'll be the weakest first quarter since COVID and a great recession before that. So that's clearly a recession signal right there. So anyway, let's just say I'm not convinced that the worst is behind us for the markets. Another thing that I've been really focused on for years now, as you know, is corporate credit. And the situation there just continues to devolve. And we're finally starting to see that reflected in asset prices, with junk yields and even investment grade yields moving higher and spreads widening dramatically, because you've had this sort of rally in treasuries, and nominal rates in both investment grade and high yield have moved higher in the face of it. So you've had a pretty significant widening of spreads, which is new and different. We hadn't seen that prior. So I think there are signs that this reversal in the markets, in the stock market, is really just kind of unbridled enthusiasm with very little basis in reality. Well, as I like to say, the journey of 1,000 miles begins with a single step. Obviously not my expression, but I repurpose it when it comes to these credit spread things, because, you see a lot of people who do that more expansive history, and you can barely identify that there's been any widening of spreads if you put it in the context of, let's say, the last dozen years or so. So absolutely true that it's been modest, but it has been more significant than anything we've seen over the last couple years in the face of this largest wave of corporate bankruptcy filings since the global financial crisis. So it's interesting that all of that unfolded last year, and spreads, we went through periods where spreads would back up a little bit, but nothing on the magnitude that they are currently. And again, I think you are starting to see that this is becoming a little bit more of a problem that's being acknowledged in the corporate sphere. Moody's came out with a report last week where they have their own sort of early warning system where they identify stress, default probabilities, in different sectors. This is interesting to me because those of us who went through the subprime crisis and the financial crisis that followed that well recall that Moody's and the other ratings agencies were way too Pollyannish. They're very restrained in their concerns about the subprime market, I would say even borderline dismissive. Now they seem to be seeing a lot of stress forming, and these early warning systems that they have are triggering, 30-40% of companies in different industries, like specifically media, healthcare, are at risk of default. So those are huge numbers. And if Moody's identifying that kind of level of problem, and of course their hair isn't on fire because they just, this is our early warning system and blah, blah, blah. But to me, it's an indication that there are real stresses out there that are catching the attention even of these ratings agencies that tend to be fairly restrained. So that is also different. But I think the key will come down to earnings. And that's the other moving part that we're starting to finally see, is that earnings estimates are being revised downward, which is generally a real headwind for stocks and for credit, because obviously if you're not going to earn as much, you're going to have even harder time servicing debt that's rolling at higher rates. And just by way of a reminder, corporate sector has to roll $1 trillion worth of paper between now and year end. And then once they get done with that, there's another 1.2 trillion lined up for 2026. So there's no respite here. And unless interest rates really start to come down dramatically, they're going to face significantly higher debt service in an environment where their earnings are slowing, if not actually declining. The competition for capital is going to be fierce out there between the public and private sector, which kind of brings us, if I can, weave it back to the Fed last week, because, I thought the decision to taper the taper was the most important thing that came out of the meeting last week. And of course, Jay Powell spun it as a technical adjustment, as if the expansion of the balance sheet was a technical adjustment to what? Right. How can slowing the runoff not be a policy function? It's clearly a response to something. If everything was so fine, why did you change anything? So it was a completely disingenuous spin on his part of what the committee decided to do. But the reason I dovetail this back to the conversation about credit issuance and the 10 trillion in debt that needs to be refinanced by the public sector is that the last thing we need right now, when we've got 10 trillion in debt that matures, treasury debt that matures, and foreigners, as we learned the day of the press conference with the Treasury capital flows, sold another $50 billion in the latest month of our paper, is for the Fed to be selling on top of it. That's just not anything we need. And at least we can control that part of it. We can't force foreigners to buy our paper, or Trump may eventually try to do that with these tariffs, but the Fed can at least get out of the way. And I think that's kind of what's happening here, is that first they slowed the taper to 25. Now they're taking it to 5 on the way to completely stopping the balance sheet runoff. And then shortly thereafter, re-expanding the balance sheet as they come in to sop up all the excess treasury supply. That's my forecast. It has been for a long time, and I'm sticking with it. If there is no need to rescue the economy or some segments of the financial system, then they'll probably implement something like an Operation Twist. They're going to figure out a way where they can pin down the long end of the yield curve, which is really the ultimate goal here. And I think they want to do this, or certainly Secretary Bessent wants to do this, without relying on issuing T-bills to finance our deficits. So, the only way you can do that is if you're going to have more supply at the long end, you need to have more demand at the long end to meet that too. So I think you would probably come up with a little bit of a balance sheet twist situation with the Fed, under whatever guise it is, coming in and helping to manage the long end of the yield curve, like Japan's yield curve control situation, such that they can avoid using the terminology of quantitative easing, which will immediately get everyone all, hot and bothered about what's really going on out there in terms of monetary integrity, as if we had any feint of monetary integrity anymore. But, and I don't believe anything they say, nor should anybody at this point. But I think clearly they would prefer not to be buying mortgage-backed securities. And the housing market's an issue. Although I would say right now, given all the things, the threats on the horizon, what happens in the corporate market is probably has more immediacy to it because of the reverberation through the financial sector. Whereas I don't know that the housing market poses the threat that it did. It certainly doesn't pose the same threat that it did back then. Right. And I think the corporate market, because of this mushrooming in private credit and the opacity around that, but the interconnectedness of that with financial institutions could create real problems that the Fed really doesn't have much visibility into right now, and it makes it complicated. And so I would think, that's the more likely area where they might target, create some kind of long-term facility to extend credit to various segments of the corporate market rather than getting back into the housing market. Well, I would say first, I have no problem with the idea that they can have an unregulated lending system and, you can have private credit extending credit to enterprises that banks won't lend to because they're harnessed by all this burdensome regulation. I appreciate that argument and I have no problem with it. But then don't run in and bail out these people the second that they get into trouble. Like there has to be downside and there has to be pain involved in that so that these independent lenders realize that they don't have a safety net under them. Like, yeah, if you're going to extend credit to some business that has no viable business model and hope that if you get into trouble, the feds will bail you out, like that's just not an environment, that I think there's some of that moral hazard behind what's going on here. But more importantly, rather than speculating about the thought process behind some of these private credit guys, is that they are connected to the banking system because a lot of the private credit funds get funding from, banks through various programs, but also they're connected to the pension system, which is, the bee in my bonnet is that the people who have been just shoveling money into both private equity and the private credit that funds a lot of those private equity ventures are the pension funds who have been desperate to try and find higher yielding alternative assets. And so to me, I totally appreciate Scott Bessent's argument that we should be able to have a less regulated financial system. But when they get into trouble, which they're going to do right now, then we have to let the chips fall where they may and face the consequences and let the markets work out the excesses. Just like we let the markets extend the credit, they have to take the lumps when everything goes bad. And that's not how it works out. And I have to believe that when it comes home to roost on public pensions, there's no way they're not going to bail them out. I mean, how can they bail out Wall Street after the financial crisis and then say, hey, all you, policemen and firemen and teachers and whatever, sorry, you're not going to get your pension because it got blown up in some of these private equity vehicles.